The 50-year mortgage proposal by the Trump administration is a disaster of an idea, and I'm going to explain why using math, using data from what other countries are doing in their loan terms and their level of home ownership, and ultimately provide a solution of what I think would be really beneficial to the housing market at the end of this video. So stay tuned. Look out for this because this will impact you if you're a buyer or seller or an investor when we propose new products at the height of the market or past the peak to try to continue to push this market along and continue to keep asset prices high, which really hurts the next generation of home buyers who are trying to come in. So while the administration is looking at ways and paths to analyze every single variable that will make an impact on affordability for the next generation, that does not mean that'll actually help them. And in fact, it's a benefit for banks, developers, and builders across the board, not the consumer. And we can prove it with the math. So look, here's Pulte, who's Bill Pulte of Pulte Homes, the grandson of Pulte Homes, did not build it. His grandfather did. And he's basically at the FHFA saying, hey, we're working on the 50-year mortgage. It's a complete game changer. There's Trump comparing himself to Roosevelt saying, hey, let's move forward from a 30-year to a 50-year mortgage. It's a bad idea. And again, it's an attempt at making housing more affordable, and it does the exact opposite. And we will dig into why that is, including the number one factor, which is that a 50-year loan duration versus a 30-year basically means that the 50-year will have a higher interest rate than the 30-year, and it could actually make things more unaffordable. There's going to be more interest that's going to be paid to the bank, not less, and it's a huge issue. So while you might save $100 or $200 or $300 a month, your principal paydown is a lot less every single month. It's a bad deal when we look at the numbers. So this is from John Wake. This is talking about the 50-year mortgage and the home ownership rate versus homes with mortgages versus ones that don't have mortgages and they're owned cash by people. We as a society in the United States are designed to maximize mortgage ownership, not home ownership. Let's dig into what this looks like. Now, homes with mortgages are at 42%. We're number two. So 42% of the homes have mortgages. Now, own homes without mortgages, we're all the way down here. We're ranked number 26. In the total home ownership rate, we're at 65%. So we're behind all of these other countries in terms of home ownership. So we're number two in mortgages and we're number 20 in home ownership. So more people have mortgages and there's less people that have home ownership. And that's with a lot of loans being subsidized by the government and interest rates artificially manipulated downward by the government, by the Fed, for years and decades on end to try to create higher levels of home ownership. Well, we know whenever the Fed or the government steps in to try to help an asset class, it just inflates the values of that asset. And that's exactly what we've seen in real estate over the last few years. And that's exactly what we're seeing in the data that's coming through. It is not helping the next wave of consumer build wealth through real estate. It's actually pricing out the prior folks while making the people who've owned along the way, their assets have continued to rise. So it's not bringing in new generation. It's making the existing owners more wealthy, not the consumers. Other countries have 20-year mortgages and a higher home ownership rate. So the length of mortgage does not mean that we're going to have a higher home ownership rate. So that's a misconception. Just because you're making it more affordable for people does not necessarily mean that it's a good thing. And the math is the math, and we will dig into that. And it's not necessarily the best thing to do at this point in the market. And you have to question yourself, why is the government proposing this now when we're past the peak and asset prices are starting to fall? They want to prop all of it up so the next wave of consumers that can barely qualify are buying at the peak of the market to basically, cash out the builders and developers who have misplayed their hand and did not realize that the market would start moving the way that it is. So, basically, if you're a buyer right now, please be absolutely careful and look at this very closely. Of course, I'm open to all options. I believe that consumers, more options is better. However, when you have consumers that are not financially literate, they can be taken advantage of by banks, by realtors, by people putting this stuff out here on social media saying, hey, you're going to save $300 a month. You should do a 50-year mortgage. That couldn't be further from the truth. So look at this. This is the home ownership rate, 10-year census and census sample surveys from 1945 and 1956 all the way up to 2020. So homeowner owned properties, we used to have only 20-year mortgages, and that was fine. But recently we've seen the ownership actually start to move down, and that's a big problem. And right now, what this means, and this has been proposed before, right? So in 2006, right before the 2007, 2008 great financial crisis, this was proposed previously. And this is because the government, again, wants to continue to pump assets. It's the same thing that we're seeing with the credit scores. Oh, we don't need credit scores anymore. Let's look at rent payments. Let's look at all these other. Whenever they try to get creative, that means they're trying to pump the market and move it forward. So, gee, it seems like only yesterday that we were talking about the newest innovation. This is from 2006. In mortgages, the 40-year loan term, actually, it wasn't yesterday, it was January 2005. And the 40-year loan term wasn't exactly new. It had been around the record high interest rates in the 1980s without ever achieving real acceptance. It goes on to say that there's only approximately 5% of new mortgages in the country were written for a 40-year loan term. Now, the wrinkle is, are you ready for this? The next 50-year mortgage. This isn't a reflection of the fact that we're living longer, but rather a reaction to skyrocketing housing prices and the slow upward creep of interest rates that are now causing the number of transactions to really slow. And basically, what you're doing is you're committing yourself to an entire life of debt. Why? Because people, if you, the original idea behind this 30-year mortgage is you would get a mortgage, and then in your 50s and 60s it would be paid off. You would no longer have the mortgage payments in your golden years, and you could continue to live them out. Now, I mean, if you have a 50-year mortgage, you're paying all. If you're buying in your 20s, you're doing it in your 70s. Well, the average, the median home buyer today is 40 years old. So if you get a 50-year mortgage, you're paying your mortgage all the way up until you're 90 years old. It does not make sense for people to get this mortgage rate. And I'll tell you again, it's 50 basis points, approximately 50 basis points higher to get a mortgage at 50 years than it is on 30 years. That's according to the estimates that we're looking at right now. It could actually be more expensive. And of course, you're going to be paying a lot more interest over the life of that loan because of the longer duration of it. So let's see, how much do you actually save on the mortgage? So this comes from Melody Wright. In case you haven't seen this one, here's an example of an amortization schedule. And so there's this idea, if you're buying a median priced house around 400,000, you're going to save about $200 a month, which $2,400 a year. However, this also means that in 1 year you're paying $24,000 of interest to the bank, and your loan balance goes down by pretty much $1,000, which is awful. So what are you assuming for your home price appreciation? You have to be betting that home prices will continue to move up in this type of scenario. And the question is this even true? This is assuming that the interest rate is going to be the same between the 30-year and the 50-year, which we know is not true. So again, the administration completely does not understand how mortgages work. They don't know how the math works on the amortization schedule, because they should have mathed this all out before making some sort of announcement like this, because it is terrifying, the lack of understanding of how this industry works. While I appreciate them trying to find solutions for affordability, the best thing they can do is just back off and not be involved and continue to try to manipulate prices higher and let the market reset to where it actually needs to be. So look at this. This is in 2021. You could buy a $500,000 house at a 3% interest rate. Your payment was around $2,100, and the mortgage was a 30-year mortgage. Total interest payments over the life of the loan is $257,000. Okay. Now in 2025, you buy that same $500,000 house. It's not 7%. It's really around 6.35 right now, but let's assume 7%. And your mortgage is a 50-year mortgage. Over those 50 years, your total interest payments is over $1 million. So you're paying for the house twice to be able to purchase the property, and it's unbelievable. So again, you pay 2 times the value, up to 4x what you could buy in 2021 on a 30-year mortgage. This is why the math just simply does not make sense. It's not a good idea to be able to just extend these terms moving forward and forward and forward. So keeping in mind, again, 50 years is going to be 50 bips higher than a 30-year. So it might help a few people who are on the edge of qualifying and don't qualify. That's wonderful. However, that does not mean that they should be doing this. So here's the math on a $400,000 mortgage, right? 30-year fixed it. This is the real numbers today. Let's say 3.75. That gives you the payment of $2,496. The 50-year fixed at 6.875, right? 50 bips higher is $2,369. So your savings, it's not savings, it's just you're manipulating the loan term, is about $127. So you're signing up for 20 additional years of debt to save roughly $100 per month. Does that sound like a deal to you? That is not affordability. That's desperation dressed up as innovation, right? They're just trying to create a new product because they realize that the prices need to come down. They don't want them to fall. If the product gets open to investors, they'll use it. I 100% believe this. Investors will like the additional cash flow. They don't care about the length of the mortgage. They care about getting the cash flow every single month. Stretching the debt over 50 years makes sense for rentals to cash flow better, which is true. Which means more single family homes will end up in the hand of investors instead of first time home buyers. So this actually could go the opposite way that we see, which is we're trying to create more home ownership, and instead we're creating more investors because of this type of product. Arguments for this situation is that, hey, maybe buyers, because of moving it to 50 years, could afford up to about 10% more house. It's good for investors because there's more cash flow. And people stay in their house for 12 years. Look at this chart. In 2006, people were rotating their houses very, very quickly, within 6.7 years. This was fine. Principal pay down for 6 years is what it is over 30-year. Principal pay down over a 50-year mortgage is much, much less. The amount of equity pay down that you're going to have is going to be tremendously lower. And this is a problem because if you buy at the peak of the market and it turns over, then you could be underwater very, very quickly because you lack that principal pay down because your loan term is so long. But now people are staying in their house about 12 years. So look, the argument is, hey, they're going to save a couple $100s a month. They're just going to stay in their house for 12 years. Well, the problem with staying in your house 12 years is that you have to pay a lot of money to get into your house in the first place, right? So you might have to pay your closing costs, your title company, your mortgage loan officer. You may even pay your realtor, 2 to 3%. You could be paying, let's say 4% on the way in to purchase a house. Well, when you go to sell your house, the transaction cost to do that is another 6, 7%. Let's just assume to get in and out of this asset, you're paying 10% on the asset value. So if it's a $400,000 house, you're paying 40 grand. You also have maintenance costs, improvements, all this stuff over the decade that you own the home to try to keep it up to value. But if prices start to fall, it makes it a really, really bad investment for the consumer if they're only staying in the property for 12 years. And if they get a 50-year mortgage and they don't have the principal pay down that they would on a 30-year, that could make it even worse. So that's the arguments for why folks really think this product is good, right? And the most people who come out here who are saying, hey, this product is great. It's going to be a loan officer. It's going to be a realtor. It's going to be, hey, you can save so much money by this. They're trying to sell you a house at one of the worst times in affordability crisis ever in history. That is why they're saying that. And I do think, again, the product will be really good for investors because it frees up more cash flow. In the short term, that means that the first-time home buyers will be competing with more investors. So here's my argument, right? So the maybe 10% more, this is designed for the weakest borrowers paying at the peak. Good for investors, sure, it's positive for them. And then 12 years is not very long, and the transaction costs are high, and there's much less principal pay down and more likelihood that they're going to be underwater during that period if we don't see prices continue to go up at 4%, which in my opinion, I don't think we will see because we're seeing a massive number of sellers come onto the market. Buyers are completely priced out. If we don't see a combination of prices coming down and interest rates coming down, then it's very unlikely that we're going to see a massive wave of buyers come in. Not to mention demographics from the silver tsunami are unbelievably bad. There's 15.6 million boomers or older that sadly will pass away over the next, decade and a half. It can get really ugly out there. These houses will go on the market. They'll be listed. They'll resell. About 70% of them will resell, and they're going to need work. And they're just going to flood the market with a ton of inventory. And because the median home buyer today is 40 years old, people aren't buying houses, they're not getting married, they're not having kids. So the demographics are looking worse. We have like this older generation who owns all the homes who are passing away. And then we have the young generations that literally aren't creating families and having kids. So who is going to be the buyer in the next 30 years of this real estate while we already have an oversupply, especially here in the South? So it is really terrifying when you look at it from that perspective. So this is my opinion, all right? Because I don't want to just complain about the problem, the proposal, and say, hey, it's a bad proposal, which I absolutely do think it's a bad proposal. I don't think it's going to do what it's intended to do. It's actually going to create opposite incentives. This is what I think could actually work. If we had a policy where the conventional loans could be assumable, right? So if you qualify for that mortgage, you could get that lower mortgage rate from the person that bought in 2020, 2021, maybe even 2022, and before rates started skyrocketing. So you could just say, hey, I'm qualified, I'm going to put a certain amount down, and you could just transact with the homeowner directly and assume the loan that they have and continue to make payments on their loan versus originating a new one at today's rates. This would make mobility of being able to sell and buy much easier and people to swap houses. And this would be fantastic for consumers. But why wouldn't this work? Well, builders would be against it because they have a lot of new construction inventory. And if your inventory on existing homes have a lower rate, there you're competing against their rate buy downs that they're having right now on their new construction. And that would be a problem for them. So even though this is a great idea, the industry will revolt against it because it doesn't help them, it helps the consumers. Lenders would be against it absolutely because they don't get to originate new loans. It's just going to be assumed. Realtors would be against it because it creates more work for them, right? They have to figure out, is this loan, what's the rules on the assumable loan? Do I actually get compensated the same when we do this assumable loan? People can do it off market. So every industry, member would be completely against making all these loans assumable, even though it would be a common sense thing to do. And unfortunately, I don't think it'll happen, but this is a way that I think that would really, really help the consumer and solve a lot of the problems that we're experiencing today. So, what do you think? Should the government continue to manipulate housing like they've always done and continue pumping it up, locking out the next generation to be able to purchase? Okay. And should they stop meddling in the asset class and let the next generation come in and start purchasing? I would love to hear from you on what you think about this, the math that you're seeing out there. I'd love to hear if you're for it, if you're against it after listening to the data that was shared today, and start another conversation because I think this is something that we should all be talking about because it is like the number one issue that the young generation is facing is this affordability crisis. And it starts with them paying 40 to 50, up to 40 to 50% of their earned income on shelter costs just to live, not to mention the health insurance premiums going up, taxes are going up, everything, inflation is going up, all the groceries. It's really tough out there for the next generation. And I really am curious if you think that the government should continue to pump these assets higher or let things reset so we can get back to a new normal without the government manipulating everything. Love to hear from you as always. You can comment below and you can follow me on Substack for information I can't say here on YouTube. Love chatting with you. See you soon.